And you know, when you're a designated market maker for a certain product, and you're the only one there, you know, there might be only a handful of you. Normally, you guys are playing the same game, so you might get one or two or three jackasses that come in and start buying. You know, maybe they try to outbid you. It doesn't matter. You can outbid them, or you can pull your bids away, and then you fill them on your offer, and then you pull your bid down, and then they get screwed, right? Because there's no other liquidity to trade against. They placed a bid, and then you pulled your bid, and you filled them on the offer. You know what I mean? That's the kind of stuff these market makers do. That's what they can do. I mean, when you're the only puppy doing business there, and there's no one else trading it. So again, you not worth it. You know, you want to at least trade in a playing field where there's like, you know, there's more idiots you can take their money from, you know? And, you know, that's kind of an evil way of looking at it, but at the end of the day, that's what it is. Yeah, for scalping, you're going to get absolutely shithoused if you start trading micros and over trading them. All I can picture is, you know, those Wojak memes? Someone has to make a Wojak meme about someone scalping micros, where you have Wojak on one side and then you have the evil guy Bogdanov, where he's like the CME, right? And you have this, and the CME is basically laughing in your face every time you're over trading on the micros, because the person does not know that you're just getting royally, absolutely effed up the ass in commissions. If you're trying to scalp them, that is. For position trading, it's different. You can get away with it, right? Because if you're going for like 20, 30, 40, 50 ticks, you know, you can get away with $1, $2 commission. It's not the end of the world. But if you're trying to scalp for 5, 6, 7 ticks, you're going to have trouble making money. Quest Trade and all these other ones, they're royally effing you up the ass in fees, you know? You know, at the end of the day, you're running a business, right? As a trader, you're running a business, and you need to understand how much your business is being impacted by fees, right? So if you can lower your fees, lower them, right? You're not going to keep high fees for nothing. You got to understand the free thing, the free zero commission thing, is not really free. I'll explain to you what it is, to my knowledge. So basically, anytime a broker offers is advertising free commissions, the only reason it's free is because they are being paid by third-party market makers for that order flow. So the broker tells the client it's free commission, but really what they're doing is, when you submit a limit order, and I'll just make sure on simulation mode, when you submit a limit order, I want to buy the stock at this price, this order goes to the other liquidity provider first. So these guys see it, Citadel, whoever it is that paid your broker for the order flow, okay? And what happens is, when you place this order here for a stock, you are in the back of the line. Like, imagine the lines that people line up for these places during COVID and whatever. You're all the way at the back and more. You might as well just go straight to the dumpster, because you're not going to get filled at the price you want, because all of the other orders are in front of you. You're at the back of the line, first of all. And by the time you do get filled, you will be, if you get filled on a bid at 770, the only way for that to happen is the market is already down here. At that moment, of course, they will fill your order, right? So that's how the free commission works. Whereas if you trade futures, for example, if I show you, you know, these are treasury bonds, okay? When I place, again, I'm just gonna make sure I'm on simulation mode, there we go. And you're not gonna see an order appear here because I'm gonna trade simulation mode, but if I was on my live account, you would see a number get added to the order book, right? So if I add an order to the book right here at 28.50, okay, I'm now 890th in the line, meaning that if some orders pull away off of this bid, my queue position gets moved up closer to the front of the line, meaning that I have more priority in the queue, right? So this is a system called a matching engine called first in, first out. And again, it's not only that I explained to you. There's also priority given to designated market makers. There's priority given to larger orders and all that stuff. So if you submit a 1 lot, there's going to be other orders that are in front of you, because if someone comes in and submits a 10 lot, his 10 lot has priority over my 1 lot. That's how their system works, I think, at least. If you're trading on Chicago, your order is directly on the exchange. Now, you also got to understand that some of the biggest routing services like CQG or Rhythmic, they're able to see the orders of thousands and thousands of traders, right? So technically, if they wanted to, they could create algorithms that are designed to follow traders that are proven to be making money. And also they could create algorithms to trade against traders that are proven to lose money. And I would not be surprised if they did this, because big companies that see all the orders of all clients, right? CQG, right? They can see orders of thousands and thousands of traders, institutional traders as well as retail traders. And it's probably illegal for them to trade against clients and stuff, but you know, how could anybody prove that they're doing that, right? So again, we're going into some gray areas here. If you're starting to scalp, you know, Tesla calls, or if you're starting to get into like these penny stocks and then they're pumping away and you're making like hundreds and hundreds of percent, they might ring your doorbell. They might say, hey buddy, you gotta pay some taxes, or else you're gonna have to move to Texas. I have a lot of private videos that I only share with about 10 traders or so, guys that I've known for a while, and I kind of document my progress and whatnot. I don't share it publicly just because, you know, it's like your business, right? It's like you're literally disclosing every little nuance about your business. You know, what successful business do you know that discloses all of their business models and details and their little tricks and little secrets that help them stay out of trouble and all of that stuff, you know? None. Real successful businesses don't do that, because they know that if they do, there's going to be 10 other competitors come and say, okay, look what he's doing. Okay, let's do the opposite, you know, or look what he's doing. Let's fade him, or let's do this, or let's do that, you know, because this is a real thing, you know. Traders, man, they're always looking for the next big way to kind of take a few ticks out of the market, right? So if you have something that's working, why would you share it? Why would you just say, hey guys, look at this, you know? I'm not gonna fucking do that. I'm not trying to sit here trying to say, yo, my method's the best, trade this way and you're gonna make money. There's tons of other motherfuckers on YouTube that do live streams just to promote their fucking trading course. They say, buy my volume profile course. Okay. Johnson says, so I'm just starting to learn futures and I have this curiosity about the saying that 99% of traders are fail. Well, listen, dude, it's just a general statement that people say that, and it's a true statement, because any professional level sport, you know, what's the percentage of people that get into the NHL out of all people that play hockey when they're young? Come on. What's the percentage of people that play golf professionally, that out of people that play golf, you know, in total? Like, come on, dude. What's the percentage of musicians that end up playing, you know, huge venues for like, you know, a huge tour, that end up landing a huge tour? Not a lot. You know what I'm saying? It's the same principle. It just so happens that trading is something that anybody can pick up tomorrow if they wanted to. But really, especially day trading, totally a discipline thing. You know, you really need to understand your environment. You need to understand your strategy, understand what it is you're doing, why you're doing it. You know, where you fail, where you made a mistake, improvement, make small adjustments. You're focusing on being process oriented, not results oriented. It's a craft. You know, it's not just like something that you can just pick up. There's a misconception out there that people say, buy my course and you can learn how to trade. You know, that's total bullshit, bro. It's like saying, buy my course and you'll learn how to shred the guitar. Well, you still have to put the hours in to learn how to play the fucking thing. Yeah, Mohammed, you made a good point about the fact that you are working with the people who control the financial kind of roller coaster. You're working with them. You're right, sir. You know, there's a lot of misconceptions that new traders have, I think, or kind of rumors that traders spread. And they'll say things like, oh, these algos are so fast I can't keep up with them. You know, stories like that in regarding to the development of high frequency trading and how markets have changed and all of that, okay? But even with the rise of these types of algorithms, in my opinion, there is still ticks to be taken out of the market by manual traders. All you have to do is just think the next step ahead sometimes. And I'm trying to make it sound simple, but it's not that simple, right? So if you take any time at all and watch, for example, the treasury bond market, this is a market that I've been watching lately, US treasuries, you have to study other traders' kind of work that they share regarding some of these markets, like things you have to chat with other traders who have experience watching these markets and all that stuff. But like at the end of the day, look, the algorithms are meant to mainly trade on the inside bid and offer. We're talking about the high frequency market making algorithms, the ones that pull away 200 lots and add them back, and arbitrageurs that when 1,000 lots print on the offer there, you see the offer pull away on the other contract, right? Those are arbitrage orders, that type of stuff. I've seen big traders, right? You have to watch the market to see this. I've seen big traders that are literally manipulating the algorithms to work for them. And you have to just watch this. I'm really limited in how I can explain it to you guys here, but you have to literally just get used to watching the market and develop your setup and just learn how the market operates. So, if you're a big guy and you can move 1,000, 2,000, 10,000, or even 100,000 contracts, you have a shit ton of feelers you could throw out in the market, right? So let's say you're a big guy, right? And for whatever reason, you want the market to go higher. But the thing is, in order to go higher, you're not just going to buy it to make it go higher. You need to seek out some more liquidity that's going to help you to move the market higher. So you'll start to see some of these games being played where you'll see, they'll push it up 2 ticks, try to get some traders to buy the offer. And then when they get filled on their offer, they'll pull their bid away. And then they'll trigger stops 2 ticks down. And then when they get enough sellers to sell on that bid, and then all of a sudden they pull their offer away, there's no more offer, and then the thing is going for 3 ticks higher, right? So certain games like this they play into the setup of how the price action has to set up sometimes for a trade to work out. Yeah, Mohamed Manul, I've received this question a lot, and I have thought about it actually, yes. I would say in my current trading method, I'm partially automated, not automated to the point where if I'm over, I can be like taking a crap and making money at the same time in a trade on the treasuries. I can't do that, unfortunately. I need to really be watching it because, there is a skill in being a discretionary trader. Like there's certain aspects of trading that I believe if you are discretionary, you can extract a better return. I'm partially automated. Like some of the calculations that I do for my trading that are in regards to measuring the volatility and all of that, all these calculations are being done automatically for me because I've kind of programmed them into Sierra chart. And I'm really happy I was able to do that. In regards to the algorithm thing, you really need the help of a master developer to do a lot of this stuff because it's like, well, number one, you really got to know your method well enough that you're able to kind of code it totally. But even with that, I feel like there's certain aspects of like a discretionary way of trading that you simply cannot tell a bot to do that. Like there's just certain things like you just know that the bot wouldn't know. Or maybe there's just certain things about your trading because you've traded for so long that you don't even know how to explain that. And this is a real thing too. It's called intuition. It's called pure experience in your marketplace. How can you teach a robot pure intuition experience about what you know that you're supposed to see upon entering a trade, And sometimes it's so subtle. It could be the difference between the market going against you 1 extra tick or the market stops 1 tick before your entry and absorbs 2,000 contracts, and that's not what you're supposed to see. How the hell are you supposed to code that into a machine to tell the machine that if it sees that, pull the order away right now or look to scratch the trade immediately, right? So like, you're really going into a deep world, man. You judge what a loser is based on your ability to conceptualize your strategy and what's supposed to happen, So like, if you're looking to scalp and it's going against you, normally the right choice is to get out. But if you're looking to position trade and it's going against you, now your management strategy is different because that's a different strategy, right? So your style of management needs to be adapted to what you do as a trader, right? So if I buy a stock and I know I'm going to probably want to invest in this stock for the next 5 years, well, if it goes against me, I'm happy because I can buy more at a lower price, right? And also if it goes up and it goes higher, I can still buy more. I'm in the trade and other traders are also buying it, meaning that I have the right idea. So I can buy more higher, right? So when you're investing, it's a different sort of management than when you're trading. Please don't take my advice on any of this, because this is not advice. When you take trades, it's important to review them not too long after you take them. That's something I learned, because if you don't review them, you're going to forget what happened. You're not going to understand the context that was there, that contributed to why you might have made that decision, or the context that was there in the overall market. So I definitely like to explain the trade as I'm taking it and after I take it as well. And then if you didn't do it, definitely take some time to do it at some point later in the session if you can. All right. Your process of reviewing and editing, if you have to make small adjustments, as you become more experienced as a trader, it definitely becomes a lot more fine-tuned. And you'll notice this as you improve as a trader. You're going to notice that your process of reviewing is going to slightly change, and it'll be more nuanced, and you're going to focus on sort of more specific aspects of very nuanced things in your trading. And that's all I got to say. All right, guys. So take care.